Gold loses its shine. Why prices are falling despite global conflict. Gold has traditionally been the world's ultimate safe haven asset during times of war, economic uncertainty, and inflation. Yet in an unexpected twist, gold prices are falling even as geopolitical tensions remain elevated. The latest decline reflects a powerful shift in investor sentiment. Instead of buying gold, markets are increasingly focused on higher interest rates, stronger government bond yields, and expectations that inflation will remain stubbornly high. This unusual market behavior highlights how monetary policy can sometimes outweigh geopolitical risk. Why is gold falling? Normally, investors rush to gold during international crises because it preserves wealth when financial markets become volatile. However, today's environment is different. Several factors are pushing gold lower. 1. Rising interest rates. The biggest driver is expectations that central banks, particularly the U.S. Federal Reserve, will keep interest rates higher for longer. Unlike bonds or savings accounts, gold produces no income. As interest rates rise, government bonds become more attractive. Investors can earn higher returns elsewhere. Demand for gold weakens. Point 2. Stronger U.S. dollar. Gold is priced globally in U.S. dollars. When the dollar strengthens, gold becomes more expensive for overseas buyers. International demand falls. Prices come under pressure. Investors are rotating into other assets. Rather than hiding in gold, many institutional investors are moving capital into high-yield government bonds, cash equities with attractive growth prospects, artificial intelligence and technology investments. This shift reduces demand for traditional safe haven assets. 4. Inflation has changed the narrative. Usually inflation boosts gold. This time, however, higher energy prices have increased inflation expectations. Markets now believe central banks will respond with tighter monetary policy. Ironically, the fear of higher interest rates has become stronger than the fear of inflation itself. The Iran conflict hasn't helped gold. Historically, wars send gold prices soaring. Yet despite ongoing conflict involving Iran and regional instability, gold has struggled. Markets appear to believe that interest rates matter more than geopolitical uncertainty. Investors are prioritizing yield over safety. Economic policy is driving markets more than conflict. This represents one of the most unusual market reactions in recent years. What this means for investors' short-term outlook. Gold may remain under pressure if interest rates continue rising, inflation stays elevated, bond yields remain attractive. Long-term outlook. Many analysts still believe gold retains its long-term value because central banks continue holding significant gold reserves. Gold remains an effective hedge against currency weakness. Future economic slowdowns could eventually reverse current trends. In other words, short-term weakness does not necessarily change gold's long-term investment case. Key market drivers to watch: factor impact on gold, higher interest rates, negative rising bond yields, negative strong US dollar, negative inflation, fears, mixed geopolitical conflict, normally positive, currently muted, central bank buying, positive over the long-term, market insight. The current decline demonstrates that financial markets do not always react according to historical patterns. While geopolitical tensions would usually trigger a surge in gold buying, investors are instead focusing on monetary policy and interest rates. This shift illustrates a broader market lesson. Economic fundamentals can outweigh geopolitical uncertainty when investors expect higher returns elsewhere. Conclusion: gold's recent decline is less about reduced global risk and more about changing investor priorities. Higher interest rates, stronger bond yields, and a robust US dollar are currently outweighing gold's traditional role as a safe haven. Whether this trend continues will largely depend on future inflation data, central bank decisions, and developments in global conflicts. Should monetary policy ease or recession risks increase, gold could once again regain its status as investors' preferred defensive asset.